Hi, hello friends. Welcome everyone to Option Omega, India's largest retail option traders online conference. I'm Ashok Devanampriya, the CEO of Traders Gurukul and also the host for your today's program. It's a great pleasure and honor to invite every one of you to the third edition of this beautiful options learning series. Today we are in the third session. Before we kick off, I would like to thank our media partner Money Control Pro, the largest financial portal in India with millions of daily readership on their website. I would also like to mention about our title sponsor Espresso from the family of Sher Khan, one of the leading stockbrokers in India with millions of investors as their customers. And finally, I would also like to make a special mention about Rigi, a platform for creators, influencers, and celebrities to grow, manage, and monetize their community. The speaker for today is Mr. Abhijit Phatak from Pune. He is a Chief Marketing Officer at Define Edge Securities, a SEBI registered analyst who has been trading on the basis of charts ever since 2003-2004. One of the very well-known option trainers in India. We always look up to him for knowledge. He is going to empower us today with the special topic trading positional option spreads in stocks and indices. AP sir, on behalf of Traders Gurukul, Money Control Pro, Espresso, and Rigi, I extend my warm welcome into our program as a speaker. Go ahead, sir.
Thank you.
The stage is yours.
Yeah, can I start?
Yes, sir. Go ahead.
Okay. Hello, everyone. Good evening. And I'm back here in this Traders Gurukul. This is, I think, my third or fourth appearance in these seminars, and I'm very glad to be here. So today I'll be talking about trading positional options spreads in indices as well as stocks. So everyone knows that trading options, of course, there are two ways. One is long, while other is short, and a lot of people get stuck in long options without knowing what exactly is happening. It is almost like trading blindly or gambling, you can say. I mean, if someone just says Nifty is going to 17,000, they'll go and end up buying a 17,000 call without even knowing or understanding how many days are left to expiry, or what is the momentum. Is there any momentum at all? So there are so many things which affect long options. But what I'm going to talk about today is a bit safer way where risk is defined. Of course, the profit is also defined, but then that is a safer way to. It's always better to be safe and consistent rather than very erratic. There is no point in having good trades maybe once in a month and 5-6 bad trades. It's always better to have a safe and consistent trades in options, and for that spreads are very useful. So just a brief introduction about me. I have been in the market for almost 20 years now, and almost right from the beginning, something like 2005, 2006, I started looking at options via charts. Of course, I studied Greeks also, but to me, it is a bit subjective, and you need deep knowledge of the subject to really implement it. And on the other hand, charts are something which, as they say, speak 1,000 words. So if I have 10 charts, I have 10,000 words. So as simple as that. And over the years, they have been very useful to me. And not only the options charts, then we advanced to straddles, strangles, OI charts, put call ratio. And now, of course, we also have multi-leg charts in TradePoint, which can plot spreads. So the typical thing in spreads is there is a maximum loss which is possible. There is a maximum profit which is possible. So just to show you how it looks like, this is a payoff. I have just plotted it just now. So in case you have a bearish view on Nifty from here for whatever reasons, so you short And since we are only 5 days to expiry, it's always better to trade the next month's expiry. I always look at spreads for monthly expiry, not for weekly expiry, because weekly can be fast, and monthly spreads give enough time to really think and then take a deep breath and enter. There's no hurry. Even 15-20 minutes here and there, it doesn't matter because the spread is not going to change very fast. So this is just a payoff which I have plotted today, which is shorting 16,700 call and going long 17,000 call. So this is just an example. This is not a suggested trade in any case. So the probability of profit is 55.77%. Maximum profit is 7195. Maximum loss is 7805. And this trade is okay as long as Nifty remains below 16,843 for the month of August. So basically, expiry in August should be below 16,843. Then this comes into profit. Above that, the loss starts. Now, the biggest problem here is a lot of people do these trades by looking at the maximum profit, maximum loss. So this is a credit spread. Another way is a debit spread. So again, the same bearish view where I have a 16,700 put long and a 16,400 put short, just 300 points away strike price I've taken. And this is also requires less margin than the credit spread. This gives profit only below 16,588. Maximum profit is 9,400. Maximum loss is 5,595. So the maximum loss is less in this case. But if you see the probability of profit, this is 43.82 and this is 55.77. So this is the most important thing in spreads, debit spread and credit spread. So either you can have a naked long option like what we see on the screen, buy a call option when you have a bullish view, buy a put option when you have a bearish view. But the problem with naked long options is you must have momentum on your side. Otherwise, if the underlying goes sideways, the option is going to lose value. And as everyone knows, the options premium consists of two components. One is the intrinsic value, one is the time value. So if the stock is sideways, it will lose premium, and then you won't be able to make profit, or maybe sometimes you might make a loss as well. So that's why naked longs, whether it is call or put, requires momentum either on the upside or on the downside. A lot of people say, but yes, we have undefined profit potential. To me, that undefined profit potential doesn't mean anything. For the simple reason that let's say you have bought a call at 50 rupees and overnight it opens at 100 rupees or maybe 150 rupees. Your first reaction as a normal trader will be to book profit. No one talks or no one even thinks of trailing it. Very few. I mean, when I say no one, I am talking about majority. Majority are looking to book it. So this undefined profit is all on paper for most of the people. And that is a fact. I have seen myself, I have experienced myself. So whenever you see a big gain, you end up booking the call. And the problem is the next part of it is more dangerous for traders because once they book a call, long call, they immediately start thinking of buying a put. This is not a joke. There are a lot of people I have seen once. I mean, you are not going to decide what is the direction of the underlying Nifty or wherever. So when you book a call, it doesn't mean that the move has ended. People immediately buy a put, thinking कि बहुत हो गया, now the rally is going to stop or maybe it is going to reverse. And then they lose all of whatever they have gained in that long call. The only advantage in in buying a naked call or put is the maximum loss is the premium you pay to buy them. So if I have bought a call at say 50 rupees and it's a Nifty call, I will not spend a single paisa more than 2,500 or slightly more with taxes and duties. The problem in these strategies, these are low probability strategies, 30 to 50%. Like I said, you necessarily need momentum on your side. Otherwise, the theta will eat up your profit and it may not go anywhere. Direction, momentum of the direction, time and volatility should be in your favor. These strategies of naked call, naked put largely work when the options premium is low or the implied volatility is low. But it is very difficult to identify all of this for a trader. Whether there is going to be momentum, that is $1 million question. No one knows. If you buy a call or a put today, no one knows that there is going to be a fast move. I mean, that is something which no one can predict. So it is a matter of chance. That is the biggest problem of long options. Now, coming to vertical spreads, what happens in vertical spreads is when you want to go long, there are two types of spreads. One is a debit spread, one is a credit spread. So in this case, buying a call or a put option and at the same time selling a call or put option of a different strike of the same expiry, which is slightly more out of the money. This captures moderate underlying moves. It has a limited risk bullish or bearish positions, but the probability of profit is much more than a naked option. This minimizes risks associated with long options for the simple reason that you have one leg short. So even if there is a fall in momentum or a sideways action on the underlying, the short side of the spread will help you, and that will give you some gain. So in effectively the overall loss in profit or maybe sometimes net loss will be much lesser. Of course, then there are different kinds of spreads under different volatility conditions, low IV, high IV. If you can combine directional spreads as well as implied volatility, then you can be a successful trader in these kind of setups. Of course, I am going to explain hardly any theory. Most of it will be examples only. So this is just a example, old example where again, like I said, this is a example of a spread. Now there are two, like I said, one is a debit spread, one is a credit spread. In debit spread, what you do is you have to buy the at the money or maybe in the money option. Let's say you are bullish, so you buy at the money call and sell out of the money call. Typically, for a monthly expiry, the range between the long and short should be about 300 points. So let's say if you are bullish from here, you buy the 16,700 call and short the 17,000 call. Again, since this is very close to expiry, it's always better to start with the next month's expiry. So bull call spread and bear put spread strategies. So this is buying the spread because here you're paying more in when you buy at the money, and that's why it is a debit spread. The credit spread is where you sell the option in the direction of whatever you are thinking of Nifty. So in this case, if you are bullish on Nifty, you have to sell the put. That is a bullish trade, isn't it? And buy out of the money put. So same strategy, let's say bullish at 16,700. A debit spread is buy 16,700 call and short 17,000 call. That is a debit spread. A credit spread is short 16,700 put and buy out of the money, which is 16,400 put. And since, like I said, only 4 days left for expiry, it's always better to go with the next month's expiry. In this case, credit spreads have higher probability of profit, which I showed in the payoff earlier. Only thing is when the IV conditions are very low, debit spreads can do well because, like I said, the IV conditions are low, so they are low priced. Credit spreads are less directional. Of course, this is something which I'll show with examples. Like I said, even if let's say you want to buy a long call, you have to act fast because it might just run away. In this case, even if you act after 5 minutes, you are anyway going to do two trades. So it doesn't, the spread very rarely changes in the matter of 5-10 minutes. You have enough time to enter the spread. Credit spreads profit even when the underlying doesn't move. This is most important. For example, let's say you buy a 16,700 call naked and Nifty doesn't do anything, plus minus 30, plus minus 30, 40, 30, 40 for the next 2-3 days. The call is definitely going to lose value and you might end up making a loss. Whereas if you have a credit spread, in which case it will be 16,700 put short and a 16,400 put long. That is definitely going to lose value because even when the underlying is sideways, the put which is short will lose value. That is the biggest advantage of credit spreads. In debit spreads, again, you need some sort of a momentum because it is more of a directional trade naturally, because you have gone long in the at the money option, and it has to move in the direction which you want for you to make a profit. Again, in this case, if it goes sideways, the profitability will be much less. So this is a bull call spread. This is a bull put spread. Now, just to summarize, of course, this is a very small part of theory, after which I'll be immediately switching to lots of charts where actual examples will be given. So in long options, there is unlimited profit potential, which to me doesn't mean much. There is limited risk because fine, you have only paid that much and you're not going to pay anything more. Lower probability of profit, 30 to 40%. Theta decay risk, because again, like I said, when the underlying goes sideways, the option is going to lose value. Volatility risk, because when we say volatility, it can be range bound, but 100 points up, 100 points down, that kind of volatility. Again, that is going to lose premium. And again, the directional risk, of course.
Here is my personal invitation to every one of you for Traders Club 2022. This is the first residential conference ever conducted by Traders Club in the city of Bangalore in the month of September 23rd, 24th, 25th. I invited some 7-8 talented speakers across India with specific topics that us to all kinds of requirements of a professional stock trader. It's a program of this magnitude generally cost almost 2 years that we are charging. It is a beautiful program of 3 days. National Traders Championship played for the first. We have a beautiful application. We will also track the championship every day. There shall be the champion the conclave award be won. Not only that, all the fees that you paid for the program will be given back to you in the form of brokerage rates, which makes the program absolutely sir. Next, uh, we we that this program should be very clean, not it should have any impact on the pockets. However, we wanted to give very lovely experience, but this the program with 3 days of learn 2 nights day and 8 meals included, it cost about 20 plus, right? So you get a VIP class, you get brokerage, you have time access to all the recordings, an opportunity to collaborate with almost 200 to 300 full-time stock traders across India. Okay, worth 55 plus valuable knowledge coupled with best memories at a very attractive price. Next, sir, it has priced at almost 2499, roughly the price of the hotel itself, and already more than tickets. Program is going to start in about 2 months from now, and the offer will stay for option Omega participants. Log in to conclave.com and grab your seats to the content manager Fazil, who will help you with all the relevant information. I'm sure this will definitely not disappoint. Here is the third question of the series. The question is, using the bull call spread, the traders anticipate the stock or index dash. Will it rise? Will it fall? Will it be the same? Please go ahead, answer this question. Once again, fast fingers first. This first. Okay. The winner get participate free part of the Intrasun event.